HDFC Bank, a broken story, or India's biggest banking recovery opportunity. For nearly 2 decades, HDFC Bank enjoyed a reputation that few Indian companies could match. It was dependable, predictable, profitable. Quarter after quarter, the bank delivered strong loan growth, excellent asset quality, healthy margins, and consistent profit growth. Investors were willing to pay a premium because HDFC Bank rarely surprised them and almost never disappointed them. But that reputation has taken a severe beating. The share price has substantially underperformed the broader market. Investors who believed that the merger with HDFC Ltd would create an unstoppable financial services giant have instead watched the stock struggle. The obvious question is, has HDFC Bank permanently lost its magic? Or is the market overlooking a major recovery opportunity? My assessment is that HDFC Bank is not fundamentally broken, but neither should investors assume that its old glory will return automatically. The bank is dealing with 3 separate problems. 1. The financial consequences of the HDFC Ltd merger, a slower than expected recovery in profitability, a new and uncomfortable governance overhang. The probability that management will make meaningful progress on these issues over the next 12 months is, in my view, approximately 70%. But the probability that every problem will be completely resolved and that HDFC Bank will immediately regain its old premium valuation is only around 40% to 45%. That distinction is critical. The merger created scale, but damaged the financial equation. The merger between HDFC Bank and HDFC Ltd created one of the largest financial institutions in India. Strategically, the logic was compelling. HDFC Bank gained access to a gigantic housing loan portfolio. It could potentially cross-sell savings accounts, credit cards, insurance, investment products, and personal loans to millions of mortgage customers. In theory, this should have created a powerful financial ecosystem. But banking mergers are not judged only by strategic ambition. They are judged by what happens to deposits, margins, profitability, and shareholder returns. That is where the trouble began. HDFC Ltd came with a massive loan book, but it did not bring an equally large low-cost deposit franchise. Unlike a bank, HDFC Ltd had traditionally funded a considerable part of its mortgage business through bonds and institutional borrowings. Once those loans entered HDFC Bank's balance sheet, the bank had to support them with deposits and meet banking regulations such as liquidity and reserve requirements. The result was predictable. The balance sheet became significantly larger. The proportion of relatively low-yielding housing loans increased. Funding costs remained elevated. The bank's loan-to-deposit ratio became uncomfortable. Net interest margins came under pressure. The merger produced enormous scale, but temporarily reduced financial efficiency. This is the principal reason why HDFC Bank's share price has remained suppressed. The problem is not growth, it is the quality of growth. HDFC Bank's recent headline numbers do not look weak. For the June 2026 quarter, gross advances increased by approximately 15.4% year-on-year to Rs 30.61 lakh crore, while deposits rose by about 14.7% to Rs 31.70 lakh crore. Average deposits grew by 13.3%, ahead of the 10.8% growth in average advances under management. The measure more closely connected to quarterly interest income. Those are not the numbers of a collapsing franchise. The bank is still attracting customers, gathering deposits and growing loans. But the market is asking a more demanding question. How much additional profit is HDFC Bank producing from all this additional business? A bank can grow its loan book rapidly by reducing lending rates or entering lower yielding segments. It can also gather deposits rapidly by offering higher interest rates. Both actions increase size. Neither necessarily increases shareholder value. For HDFC Bank, the challenge is not merely to grow deposits and loans. It must grow them at spreads that restore profitability. That is why net interest margin, or NIM, is the single most important number to watch. Net interest margin broadly represents the difference between what the bank earns on loans and investments and what it pays for deposits and other funding, adjusted for the size of its earning assets. When margins are high, growth becomes highly profitable. When margins are compressed, a bank can become considerably larger without becoming proportionately more valuable. HDFC Bank's margins remain well below the levels investors historically associated with the franchise. Until there is visible and sustained improvement, the market is unlikely to award the bank its old valuation premium. The deposit problem is improving, but it is not solved. There are encouraging signs. Average deposit growth is now running ahead of average advances under management. That suggests that HDFC Bank is gradually repairing the funding mismatch created by the merger. This is exactly what management needed to do. However, there is an important complication. Average term deposits grew by about 14.3%, while average CASA deposits grew by a more modest 11.2% during the June quarter. CASA refers to current accounts and savings accounts, which usually provide banks with relatively cheaper funding. Term deposits are more expensive. Therefore, HDFC Bank may succeed in gathering the deposits it needs, but still struggle to improve margins quickly because it is paying more for those deposits. This is why the recovery is likely to be gradual rather than spectacular. The bank must achieve three things simultaneously. 1. Grow deposits faster than loans. 2. Improve the proportion of low-cost deposits. 3. Avoid overpaying excessively for funding. That is a difficult balancing act, even for a bank with HDFC Bank's brand and distribution network. Can management repair margins within 12 months? I would place the probability of visible margin improvement at around 60%. Why not higher? Because management does not control every variable. Margins will also be influenced by RBI policy rates, system liquidity, competition for deposits, deposit repricing loan yields, the proportion of mortgages in the loan book, competition from ICICI Bank, Axis Bank, Kotak Mahindra Bank, and public sector banks, customer preference for higher yielding term deposits. Management can improve the lending mix, increase cross-selling, reprice loans, and reduce expensive borrowings. But it can't order customers to leave their money in low-interest savings accounts. Nor can it completely escape aggressive deposit competition across the banking system. Therefore, expecting a return to HDFC Bank's historical margin structure within 4 quarters may be unrealistic. A modest and consistent improvement is far more likely. HDFC Bank has become a financial supertanker. Scale is both HDFC Bank's greatest strength and its greatest limitation. Smaller banks can increase deposits or loans by 20% from a relatively small base. HDFC Bank cannot. With deposits exceeding rupees 1 lakh crore, even 10% growth requires the mobilization of more than rupees 3 lakh crore of additional deposits. That is an extraordinary sum. The larger a bank becomes, the more difficult it is to grow faster than the overall financial system without compromising pricing or risk. HDFC Bank is now a financial supertanker. It is highly unlikely to sink because of one rough quarter. But it also cannot change direction like a speedboat. Investors accustomed to HDFC Bank delivering high teens growth and steadily rising profitability must recognize that the law of large numbers has arrived. The bank can still become substantially more valuable over time. but future returns may come from a combination of moderate business growth, improving margins, better operating leverage, strong asset quality, subsidiary value, a gradual valuation re-rating. It may no longer come from breathtaking growth alone. Asset quality is not the central concern. One reason I remain constructive is that HDFC Bank is not attempting this recovery while carrying a disastrous bad loan problem. Its fundamental credit franchise remains strong. That matters enormously. A bank with compressed margins but good asset quality has time to repair its business model. A bank with compressed margins and rapidly increasing bad loans does not. HDFC Bank's underwriting discipline, customer base, collection capabilities and risk management systems remain among the strongest in Indian banking. This gives management room to focus on deposits, margins, and operating efficiency without simultaneously fighting a balance sheet fire. Therefore, the present situation should not be confused with a conventional banking turnaround. HDFC Bank is not recovering from insolvency, reckless lending, or a capital shortage. It is recovering from an enormous merger that temporarily distorted its financial ratios. The governance issue is the biggest new wildcard. Until recently, most investors viewed HDFC Bank's problems as financial and temporary. That changed when former chairman Atanu Chakraborty resigned in March 2026, stating that certain practices at the bank were not aligned with his personal ethics. And in some way, an external legal review reportedly found no evidence supporting the broader governance concerns he raised. The RBI also stated that its periodic assessments had found no material governance concerns on record. However, the controversy did not disappear. An additional review examined reports that preferential deposit rates had been offered to the Maharashtra State Road Development Corporation. The bank's board subsequently concluded that the matter involved business overreach rather than personal benefit. Warning letters and penalties of rupees 1 lakh each were imposed on the CEO, CFO, and head of retail assets. The monetary amount is insignificant. The signaling effect is not. When the CEO and CE of India's largest private sector bank are formally penalized by their own board, investors will naturally ask questions about controls, judgment, and accountability. The controversy also contributed to uncertainty regarding CEO Sashidhar Jagdishan's reappointment, with his term due to end in October 2026. Reuters reported that management continuity had become one of the principal overhangs on the stock. This is why I assign only about a 55% probability that the governance uncertainty will be satisfactorily settled within the next 12 months. The issue may be resolved cleanly. But until leadership continuity, regulatory approval, and board management relations become clear, the market is likely to retain some governance discount. The market no longer gives HDFC Bank the benefit of the doubt. For years, investors assumed that HDFC Bank would execute well. Today, they want evidence. That is a major shift. In the past, management guidance and the bank's historical record were enough to support a premium valuation. Now, investors want to see deposits consistently growing faster than loans, improving CASA traction, better net interest margins, stronger core operating profit growth, recovery in return on assets and return on equity, clean regulatory and governance outcomes, stable senior management. The stock declined sharply during 2026 and materially underperformed both the Nifty 50 and the banking index. Reuters reported that it had fallen approximately 25% during the year by July 26, compared with an 8% decline in the Nifty 50. Part of this fall reflects weak profitability, but part of it also reflects something less measurable: the collapse of investor confidence in the old HDFC Bank narrative. The market once viewed HDFC Bank as nearly flawless. Now, it views the bank as a show me story. Why management still deserves a 70% probability of meaningful success. Despite the problems, I believe management has a good chance of delivering meaningful improvement over the next 12 months. There are several reasons. First, the deposit franchise remains formidable. Few financial institutions in India possess HDFC Bank's branch network, digital reach, corporate relationships, and brand trust. The bank can mobilize deposits. The real question is the price it must pay to obtain them. Second, loan demand remains healthy. The bank's advances are growing at a respectable pace. The business engine has not stalled. Management does not need to create demand from nothing. It needs to improve the profitability of the demand already available. The absence of a major bad loan cycle gives management time and flexibility. Fourth, the merger offers long-term cross-selling potential. Millions of mortgage customers can potentially be converted into full banking relationships. That opportunity has not disappeared merely because the first few years of integration were difficult. Fifth, the valuation no longer assumes perfection. This may be the most important point for investors. A highly valued company must deliver nearly flawless execution to produce good returns. A discounted company only needs to deliver better than feared execution. HDFC Bank does not have to return immediately to its golden period for the stock to perform. It merely needs to demonstrate that the direction of travel has changed. My 3 scenarios for the next 12 months. Scenario 1. Strong recovery. Probability 25%. In this scenario, deposits continue to grow ahead of loans. CASA growth improves. Margins rise faster than expected. Earnings growth accelerates. The CEO question is resolved. No additional governance surprises emerge. The stock experiences a meaningful re-rating. This would be the ideal outcome. It is possible, but not my base case. Scenario 2. Gradual repair. Probability 45%. This is my most likely scenario. Here, deposit mobilization remains strong. Margins improve slowly. Earnings growth becomes somewhat healthier. Asset quality remains stable. Governance concerns reduce but do not disappear immediately. The stock improves, but without returning quickly to its old premium. This would still be a satisfactory outcome for a patient investor. Scenario 3. Disappointing progress. Probability 30%. In this scenario, deposit costs remain elevated. Margin recovery is delayed. Governance or succession concerns persist. Profit growth remains ordinary. The market continues to prefer ICICI Bank or other competitors. HDFC Bank remains trapped in a valuation discount. This outcome cannot be dismissed. The bank is strong, but strength alone does not guarantee stock market returns. What investors should monitor every quarter. Do not judge HDFC Bank merely by whether net profit rises. Watch the quality beneath the profit. The 5 most important indicators are: 1. Average deposit growth. Period-end numbers can be influenced by last-minute movements. Average deposits provide a better picture of funding available throughout the quarter. 2. Average loan growth. Compare this with average deposit growth. Deposits growing faster would indicate continued balance sheet repair. 3. Net interest margin. This is the clearest measure of whether the merger-related funding pressure is easing. 4. The CASA growth. A stronger low-cost deposit franchise would improve confidence in future margins. 5. Return on assets and return on equity. Ultimately, investors own a business to earn returns on capital, not merely to celebrate the size of its balance sheet. I would also watch management continuity, regulatory disclosures, and any further governance-related developments. Is HDFC Bank a buy? For a short-term trader, HDFC Bank may remain frustrating. Avoid. The market is unlikely to restore its premium because of one strong quarter. for patient investor with a 3 to 5 year horizon. However, the stock is becoming more interesting. The investment case is no longer buy HDFC Bank because it is perfect. The case is now buy gradually because the franchise remains excellent, expectations have fallen, and the probability of operational recovery is higher than the probability of permanent deterioration. That is a very different proposition. It carries uncertainty. But uncertainty is often where future returns originate. My preference would be to accumulate gradually rather than make a large one-time purchase. A staggered approach allows investors to benefit if the recovery progresses while retaining capital in case margins or governance developments disappoint. My final verdict: HDFC Bank is not the effortless compounder it once appeared to be. It is also not the damaged institution the share price sometimes suggests. It remains one of India's most powerful financial franchises, but it is carrying the burden of a transformative merger, compressed margins, enormous scale, and a recent loss of governance confidence. My assessment is there's a 70% probability of meaningful operational improvement within 12 months, a 60% probability of visible margin improvement, a 55% probability of a satisfactory governance resolution, a 50% to 50% probability that the share price fully recognizes the improvement within the same period, a 40% to 45% probability that all major issues are substantially resolved. The stock market may recover before the numbers fully recover. Therein lies the opportunity for a long-term investor. Or the numbers may recover before investors regain confidence. A less likely scenario. That timing cannot be predicted precisely. But the central conclusion remains: HDFC Bank does not need to become perfect again. It needs to prove that the worst of the post-merger disruption is behind it. 2 or 3 consecutive quarters of stronger margins, healthier deposit growth, and clean governance developments could materially change the market narrative. Until then, HDFC Bank remains neither a blind buy nor a lost cause. It is a high-quality franchise on probation. And for patient investors, that may be exactly where the opportunity lies. My videos are not meant to be stock tips. Instead, I share my analysis of the stocks I write about. Always do your own research before buying or selling. My videos are not meant to be stock tips. Instead, I share my analysis of the stocks I write about. Always do your own research before buying or selling. If you like what I have shared in this video, do like and share with others who may be interested.